How do you calculate risk-neutral probability? Have you ever wondered how traders determine the value of options without getting tangled in the complexities of actual market risks? Today, we will break down the concept of risk-neutral probability and how to calculate it in a straightforward way. Risk-neutral probability is a method used in options trading to estimate the expected value of an asset while ignoring the real-world probabilities of various outcomes. Instead, it adjusts these probabilities so that every asset reflects the same expected return, which is equal to the risk-free rate. This approach assumes that investors are indifferent to risk when they price options, treating them as if they were risk-neutral. To simplify the valuation of options, risk-neutral probabilities are essential. The goal is to find a probability that aligns the expected return of any asset with the risk-free rate. This is done by adjusting the probabilities of upward and downward movements in the stock price. Now let's get into the calculation. To find the risk-neutral probability of an upward move, you can use a specific formula. The formula is as follows. Risk-neutral probability equals the risk-free rate plus 1, minus the return if the stock price goes down, divided by the return if the stock price goes up, minus the return if the stock price goes down. In this formula, the risk-neutral probability of an upward move is represented by the symbol pi. The risk-free rate is denoted by r. The return if the stock price goes up is r raised to the power of u, and the return if the stock price goes down is r raised to the power of d. Let's consider a practical example. Suppose the risk-free rate is for percent, and the stock price is expected to either increase by 30% or decrease by 30%. In this case, you would set r equal to 0.04, r raised to the power of u equal to 1.3, and r raised to the power of d equal to 0.7. Plugging these values into the formula gives you the risk-neutral probability of an upward move. You would calculate it as follows. First, subtract 0.7 from 1.04, which equals 0.34. Then, subtract 0.7 from 1.3, which equals 0.6. Finally, divide 0.34 by 0.6, which results in approximately 0.567. Now, to find the risk-neutral probability of a downward move, you simply subtract the upward probability from 1. In this case, 1 minus 0.567 equals approximately 0.433. These calculated probabilities help traders determine the expected payoff of an option. This expected payoff is then discounted at the risk-free rate to find the current price of the option. In the realm of options trading, risk-neutral probabilities play a vital role in valuing options without factoring in the actual likelihood of different outcomes. This method allows for easier comparison and pricing of various options. By utilizing these probabilities, traders can calculate the expected value of an option and establish its fair price based on the risk-free rate, rather than the actual probabilities of stock price movements.